Oil prices flatlined overnight as geopolitical tension eased. But the real story happened in the sector rotation. Capital abandoned semiconductor leaders, while defensive consumer staples rallied hard enough to offset broad market weakness. A single oil price drop is triggering a chain reaction you cannot ignore. Capital is coughing through tech exposure and seeking alternative routes. SMH shed 2.22% as chipmakers face earnings pressure, yet ARKK surged 0.95%, while XLI retail stocks jumped 1.33%. The data reveals a classic defensive rotation. Money leaving cyclical tech manufacturing and flowing into consumer staples that posted the strongest sector performance at plus 1.61%. Our metrics confirm this is not random noise. It is systematic risk hedging before major earnings reports including ORCL, NVDA, and VG release their guidance. Credit spreads are holding steady with minimal expansion despite the oil shock. The 10Y Treasury dropped 8 basis points to 4.64%, while high-yield funds remained essentially flat at plus 0.05%. This stability suggests institutional investors view the oil decline as a temporary supply disruption rather than demand destruction. Our credit dashboard shows borrowing costs remain manageable, but the technical weakness in SMH and IYT industrial sectors indicates capital is pricing in near-term earnings uncertainty for manufacturing-heavy names. Fear products are flatlining despite elevated VIX readings. UVXY down 1.35%, VXX down 0.76%, while VIX climbed to 1881. This inverse relationship signals that hedging demand is weakening as the worst of the oil scare has passed. The consensus among the Canary community is that fear is cooling faster than fundamentals warrant, creating a potential gap between price and sentiment for volatility plays. Our indicators confirm this. VIXY dropping while actual VIX rises suggests priced-in protection exceeds realized need. Oil collapsing 8.13% signals supply-side relief rather than demand destruction, which keeps the real economy from overreacting. CoreWeave down 43% in a year connects directly to this. Chip demand softening as manufacturing slows. Russell 2000 actually gained 0.67%, while large caps flatlined, proving small cap resilience when energy costs stabilize quickly. The data is screaming that this oil move created more technical volatility than economic impact, with earnings estimates still intact despite the headline noise. Defensive positioning emerged faster than historical averages suggest. XLP consumer staples leading at plus 1.61%, while TLT long-term treasuries gained 0.58%. GLD gold holding steady at plus 57% indicates precious metals are functioning as a stabilizer rather than a flight-to-safety panic play. Our safety metrics show portfolio hedging has begun, but the magnitude suggests this is tactical positioning for earnings season rather than full-blown recession protection. The ratio of defensive to cyclical exposure is trending toward historical defensiveness norms. The portfolio hero is currently fighting back against two villains: oil supply disruption and tech earnings uncertainty. SMH weakness and chipmaker rout created the initial threat, but the defensive rotation into XLP and retail sectors has contained damage. Fear products cooling, while VIX rises means hedging costs are still priced in appropriately. The oil crash was a technical shock that triggered sector repositioning rather than fundamental collapse. The Canary dashboard shows markets absorbing this oil volatility with minimal systemic stress, but the sector rotation signals earnings caution ahead. Watch SMH and XLP divergence as the next indicator of whether defensive positioning is accelerating or stabilizing. The data breathes easier today, but keeps monitoring that chipmaker earnings timeline.